Hey guys, this is Heather Loomis with Finance and Jeans. In this week's market recap, this is what happened. First, the S&P 500, which is effectively called the bellwether for the US stock market, rose about 1.4%. Put that into context. Since the 1950s, the S&P 500 has performed about 10% per year since inception. So 1 week's performance of 1.4% is pretty good. That's in the context of the year-to-date performance for the S&P 500, which is about 2%, a little over 2%. The big story of what's been going on in the background is that there has been a huge rally since April when Trump reversed his stance on tariffs. Effectively, the market was going up. Once he got elected, Trump announced tariffs, the market cratered, and then Trump backed off substantially, incredibly substantially, and the market rose right back up again, right to the levels basically that we were at before all this happened. People have dubbed this the taco trade, Trump always chickens out trade. Call it what you will. That's what's gone on. One of the bigger drivers of what was happening at a sub-level this week was the jobs report. The jobs report came in and we added a solid amount of jobs. Now, if you look through to where the jobs were added, it was pretty lackluster. Healthcare really carried the job market on its back. And that's been a story which we have known for a while. The baby boomers are the largest generation America has ever seen, and they are getting to the point where they are aging and requiring more services. So that healthcare component we knew was going to have to play a larger and larger role. Now, if the big beautiful bill is passed, that has some major and fairly negative implications for healthcare. But what you're going to learn through these weekly market updates is that the market tends to be relatively short-sighted. I know they're supposed to be a long-term barometer of what's going on, but in practice, it's pretty short-sighted. And so what the market was looking at this week is, jobs were okay. They weren't great, but they weren't disastrous. It's kind of like that Goldilocks, the porridge is not too cold, but it's not too hot. This is the golden scenario that the Fed likes, and the Fed feels comfortable lowering rates, especially if coupled with slightly lower inflation levels, which we have been seeing. So when the Fed is able to lower rates, that's very stimulative for the stock market. When rates are at 5.5%, you have little incentive to borrow, to take out a mortgage, or to do anything but sit in a money market earning 5.5%, taking no risk. When rates are at zero, not to say they would go from 5.5 to zero, but bear with me. When rates are at zero, you've got nothing to lose. You could you could take out a mortgage for a very low rate. You could get a small business loan for a very low rate. You are not earning anything in your money market fund or in your checking account, so you could buy bonds, you could buy stocks, and theoretically earn a little bit more. So the market this week was looking at it and saying, we're still riding the taco wave, and the Fed could be an additional wind at our back if this data keeps coming in relatively benign. What I would say about all of this is I don't really buy it. I think all this uncertainty that we have created through flip-flopping policy and chaos within the American governmental system is ultimately bad for U.S. businesses and bad for our trading. And that, combined with consumer sentiment, is the backbone of our entire economy. And the more you tamper with that, the more you cause long-term harm. And even if we are not seeing this in the daily returns to the stock market, I would keep this in the back of your head as you think about allocations and how you go about your day-to-day lives. I will see you back next week for another market summary. Enjoy your week.